Hello, everybody. Welcome to Friday and another Talk Money with Tom show. We do this every Friday from 12:15 to 1 o'clock Pacific time. I'm really glad that you could join us today. I'm looking forward to answering your questions. If you want to ask questions during the show or anytime, even during the week, and we've got a couple already this week, you just send them in to Ask Tom at talkmoneywithtom.com. And we'll have Katie, who's here on the bottom of the screen. She's our moderator. She'll be asking the questions and kind of they come into her first. She'll ask maybe some follow-up questions. And of course, Eason, who's also here on the screen, is one of our other advisors. He will be, filling in the blanks that I might, miss, or even asking some follow-up questions just so we can kind of fill it out. We believe that investor knowledge, the more that you have, the faster your wealth can grow. And that's what this show is about, actually. And so, again, if you have any questions, please send them in. If you have questions that you want us to answer in person, you can go to our website and just click the book appointment button. And you can meet with us and ask those questions that way also. You can subscribe to our channel here. We put educational content on this channel constantly, and you just hit the subscribe button and the little bell next to it. Or if you just want to send us your email and get on our email list, we can send you the links to these different videos, and that you can just send that into the Ask Tom with talkmoneywithtom.com. So I always focus on three main areas, the financial planning, the tax planning, and the investment management aspect. I'd like to start talking about the markets themselves and kind of what I saw this week and what I felt was really important, sort of a summary for the whole week as far as that goes. And so it's been a really interesting week, of course, as usual. We're in the middle of an epic time frame, really, from the stock market standpoint because of this virus that's running around and what have you, too. So let me share my screen and I'll tell you a little bit about what I'm seeing. So obviously, the first thing we start with, and I've started with this the last several weeks, is the virus itself. It is having some potential impact on what's happening with the market, and we'll talk about that. And you can see what's going on here. We've had this big run-up that's happening, via the Delta variant as far as that goes. There's some hope that this thing will peak out at some point in time and, maybe come back down. And if you look, it's kind of interesting what happened here in India, for example. They had this ginormous, run up here, and then it came back down and flattened out and what have you. So if you look there, that was in 11 weeks from their lowest point to this high point here. So if that was true, 11 weeks for us would be the first week of September. So it's coming up. We'll see what happens. Then if you look at what happened here in the UK, also a Delta variant surge, they had a 10-week run up between, that low point, but they are getting a little bit of a bounce here. So we'll have to wait and see what happens as far as that goes. But it's an ongoing piece of the story for what's going to happen, potentially with the stock market as far as that goes. This is one of the things that came out this week. This is the U.S. Retail sales report. And you can see going back over a year here, we had this giant run up here after March. And basically what's happened now, though, is that we've seen a little bit of softening in the retail sales. And that wasn't expected. It was expected to do better. But here's a couple things I'll point out that I think are really fascinating about this. Number one, if you look back at where it was in September versus where it is now, that's an amazing movement upward, huge movement. And the biggest concern back at the kind of second quarter of this year was really inflation. And it was because of this. If this kept going and we had a tremendous run of, retail sales and all the other things that were happening, you were going to have a potentially high inflationary environment, and the market was struggling with that concept. And so that's probably the good thing about what's happened so far with a little bit of softening. So for me, when I look at this in a different light than maybe the market's looking at in the short term, number one is I see that retail sales are up a lot over the last 12 months, but they're not up so much to create a huge inflationary spike. So I think that's important. The Delta variant has, though, impacted consumer confidence. And so this is a survey that's done, and you can see it kind of peaked out here back in about roughly the same time that the U.S. retail sales peaked out, and it's come back down. So this is what people are feeling about the economy, their jobs, and those types of things. And so that's starting to weigh on what's going on as far as that goes. And really, you can kind of see that here in what happened with the stock market, right? So here's the last 5 days. Every one of these little bars is 10 minutes. This blue line here is the average of the last 200 10-minute increments. And so you can tell, just follow that blue line there, that we've had some softness this week where the markets have come down. Now, one thing that's interesting, this is an all-time high. The S&P 500 goes back to 1957. That's the highest it's ever been. So that's a good thing. And then we fell off of that high down to here back early on Thursday morning. So here's a couple things I'll point out. Number one, this big drop off that happened at the end of Wednesday's trading day had to do with the Federal Reserve releasing the minutes on their meeting. So they met a couple weeks ago, and the minutes basically show what they talked about. And there was an awful lot of conversations about cutting back on the bond purchases at the end of this year. And so that's kind of an interesting piece. And that's something that the market's a little bit nervous about, especially considering the fact that retail sales are softer than expected, consumer sentiment is softer than expected, et cetera. So here's what I'll say. First of all, those minutes are, before all those reports. And, they're just talking about it. And we'll see what actually does happen. But I'm not too worried about that aspect of it. I think they're doing a good job of communicating as early as possible what's going on. But the other part that's very fascinating here is this run-up that we've had. And this is as of a couple of minutes ago altogether. And what this is showing right now is that we ended up kind of people coming in and buying the dip. This is only a 2.5% drop from the highest point to the lowest point. And then money started to come in, kind of held up yesterday, more or less sideways, and then a really good day so far today. So, it's very fascinating. There's an awful lot of money sitting on the sidelines that keeps coming in to buy the dip. And so that's a big piece. And here's what's happened in the last 12 months. And again, these are the last two bigger downturns that we've had in the last 12 months. Every one of these bars is now a day, and this is the 200-day moving average. So you can tell we're in a really strong upward market. And a matter of fact, today, at the moment, it's green. It'll be 200 days since we've had a 5% downturn or more. And so that goes back to the beginning, here, which is the end of October, all the way to today, 200 trading days. That is only happened, including this time, 8 times in total since 1957. So that's pretty rare. And I look at that in a couple different ways. Number one, it could go a lot longer. The longest is 404 days. That happened back in 2016 through 2018. So it could go a lot longer before we have another downturn of 5% or more. The one thing that I do like, I kind of like to see some of these little bigger downturns because I look at this like pressure. So if you keep going up and up and up, earnings got to keep up with that. If they don't, you could get this scenario where, basically the price gets too far ahead of the earnings and you could get a much bigger downturn. And sometimes those bigger downturns, people get scared and it turns into something even bigger than that. So I like to see these little pressure relief valves, but it does look like that, we did get some good buying coming in here. And we really don't know for sure if this is over. I would say one of the key criteria I look at is if it breaks into a new high, it could be over. And that could happen. But oftentimes you get a little bounce and then it'll go down a little bit lower. So, we'll see what happens. But the buying on the dip has been a really big deal. And money just keeps coming in and buying. It's been amazing to watch, actually. And then just to put this in a little bit of perspective, here's the last 25 years. So each one of these bars is a month. All right. And if you look, the S&P 500 is up 545% just on price appreciation in that 25-year period, even though we had the second biggest downturn in history, which was the 2008 financial crisis, and the third biggest downturn in history, which was the dot-com bubble in 2000. And so, overall, basically, if you look at the market on the long-term aspect, it's a pretty phenomenal investment vehicle as a whole, even if you did have to survive through some of these bigger downturns. And I just show this here. It's just kind of interesting. This is an Elliott oscillator that I look at on a monthly basis for a long-term, trend signal. It's only gone red twice in 25 years. Once would have been right about here. So it's kind of a signal of, hey, things could be going sideways here. And another one was right about here. So both good signals. If you look at this right here, this is the COVID downturn from last year, which doesn't look that bad in hindsight, obviously. It was a pretty dramatic move in that it happened so quickly, but with all the stimulus money that came in, things did start to recover quite well. But if you look at that Elliott, oscillator now, it's nowhere near being red. So altogether, things are, in a decent spot. And I think, again, we should see some softness here at different points in time. Things are slowing down. The Delta variant's coming up. That's creating some concerns for people, rightfully so. And maybe some people are pulling back on some of their purchases just in case, that type of thing. That's not a bad thing. I think inflation is really the biggest, piece that we really have to watch out for. That could still happen. Maybe it happens next year, what have you. This slows down that inflationary drive. So again, I think this is a nice place for the market to be able to grind out some new highs here at some point in time. But again, I wouldn't be surprised to see it go down a little bit more here in this particular downturn that we're now. But again, I see that as a good thing as far as this goes. So that's where things are right now. I look forward to talking to you again next week about it. All right, Katie, let's get started with some of the questions.
So right off the bat, Tom, we have a great question in from a man who gives us many great questions, Woody. And he's asking, Tom, after the closing bell on Thursday, CNBC folks seem a bit surprised over the down market after a good earnings report. What is their relationship?
Yeah, okay. That's a really good question actually, because there's some interesting pieces there that are difficult to understand sometimes. First of all, I'll say that the market is a forward-looking mechanism. So when companies are reporting earnings, the price for the most part has already moved for those earnings some time ago. And the only thing that really happens when the earnings are released is that sometimes there'll be earnings are higher than expected, and you'll get some motion forward because of that. So most of the motion that you would see based on the earnings that are expected has already happened before those earnings reports are reported. And so there's not a lot that happens that day. Sometimes, the earnings reports are pretty complicated. There's all kinds of forward guidance and different things that happen, along those lines. And somebody will say something, even slightly negative, and the stock will sell off, even though it had phenomenal earnings. I know that happened to Apple the last time, for example. But in the end, the overall market is looking forward. So on Thursday, the overall market is looking at, hey, the Federal Reserve might be cutting back on bond purchases, and the Delta variant is still growing, and it's growing again in the UK, and retail sales are down. And so there's kind of this negativity that's sitting on the market that wasn't there before. Some of those things weren't as expected. All of those are future looking things, and that can overwhelm positive earnings reports. There's no doubt about that. And it's why you often don't see, big moves after earnings unless it's just wildly surprising to the upside. Somebody had something that nobody expected to happen, and then sometimes you'll see the stock move from that. But it is a good question. I get asked that a lot, actually. You got to always be thinking about, what is going to be happening in the next 6 to 18 months, and then you'll get a better idea for what's happening with the market. So the market's more concerned about what the earnings will be for those companies 6 to 18 months from now, right? So that's the key. It's a forward-looking mechanism.
I know a lot of companies, even though they've had relatively good earnings reports, they've also cut guidance for future quarters with slowdowns and expected supply chain issues. And so those issues could be slowing down the market too.
Yeah, that's exactly right. It fits right in with what I was saying. The market is looking forward. And so they report their actual earnings. Let's say they were really good, even better than expected. But at the same time, they say, hey, in the next quarter or the quarter after that, depends on how much guidance they're giving, we're expecting some softness because of supply chain issues, or because of the Delta variant, or, whatever it might be, seasonality that comes along. And so that's exactly right. That has more weight oftentimes. And then there's one other interesting thing, in my personal opinion. If you're the CEO of a company and your job is to kind of beat these expectations, I'm not going to set them too high. So when I'm giving guidance, if I think I can get to 10, I might tell you I can get to 8. And then, if I get to 10 or 11, I look great, right? If I tell you I can get to 10 and I don't get there, then I've got problems. So that's why you'll often see guidance being a little bit low in terms of, in my opinion, why make the hurdle higher than you need to make it? And so, yeah, but it does fit. That's the forward aspect of looking at the market. It is looking forward, not so much for what's happening today per se. Today is a confirmation of what was expected from the past, and what we're really looking for is what's going to happen tomorrow.
Another question we have in is, I am retiring at 60. What should I be worried about compared to a normal retirement age?
Yeah, that's a good question. So, you know, normal retirement age is an interesting question, because that's definitely changing in today's world. It used to be 65. It still is to a large degree. Still have a lot of people that talk about 65. But retirement is becoming kind of this flex concept where, maybe you just switch careers into something you like to do. And I guess I'll call it financial independence is becoming a much more important concept. But if you do stop working at 60 versus, say, 65, there are a few things to consider as far as that goes. I mean, one is just that, Medicare is a pretty good program. It's fairly inexpensive, especially compared to private insurance. And you do not qualify for Medicare until age 65. So if you're going to retire at 60, you're going to pay quite a bit more, 2 to 3 times more for your healthcare
Wow.
coverage than you will once you get to be 65 and you qualify for Medicare. And for a lot of people, some of that is already being covered by work. Maybe they're only paying for half of it or what have you. And so, or even zero. Some companies pay for all of the medical costs. And so it's kind of a big shock. You retire at 60 and what have you. It is important that you're past 59 and a half when you're at age 60. 59 and a half is when you can start to get into your IRA type assets, your 401k type assets without any penalty. Still have a tax on those, but that's a good piece. You got past that if you're going to wait till age 60. I guess the other major aspect that you have to consider is just that your money has to last longer. Whatever your life expectancy is and however long you live, if you retire at 60 instead of 65, your money has to handle that 5-year, window and be able to deal with that. And so, that would be another aspect. Social Security is another one. You're not going to be adding to Social Security. You're going to be taking it between 62 and 70. So if you're not adding, you'll have a little bit less, not huge amount, but that's somewhat of an impact as far as that goes. And, those are some of the things that are off the top of my head. Anything I'm missing here, Ethan?
I think you covered most of it. And
Good.
most of the stuff we can, if you have a financial plan, you can play with this age, maybe you could retire 2 years earlier if you're willing to cut back a little bit more.
Yeah.
Or you can change up your plan just to fit your needs.
Yeah. Yeah, exactly. I mean, that's one thing that's nice about going through the financial planning, the retirement planning process, is you can test out all these concepts. Because I guess the main thing wouldn't be what's different to me. It's just, can you do it? Does it actually work? Do you have enough money? And are you willing to live at a lifestyle that will make that money last for the rest of your life? Because it becomes more acute when you retire earlier. The later you retire, the less you're going to be, putting pressure on your money. So yeah, that would be the other thing I would take a look at, is just, making sure that financial planning process is in place. So you've got a good idea for what would happen.
I am retired. I had an unexpected large expense that's bigger than my emergency fund. Where should I pull the money from to pay it? Brokerage, IRA, or Roth IRA?
Oh, okay. All right. So we have an expense that's bigger than what we have available in emergency assets. And so, basically it's called the sequence of withdrawals. This is actually one of the most important things that you need to know about in retirement, in my opinion, because an awful lot of people don't understand where to get the money from, and they take it from the wrong place, and it can have a pretty damaging effect on your retirement. So for example, probably the worst place that you just mentioned to take the money from would be the Roth IRA, for a variety of reasons. The Roth IRA grows without tax for the rest of your life. It's the most powerful asset you have that you just listed there, in my opinion. And so if you can leave that for longer and longer and longer, that just means it grows tax free for longer and longer and longer. If you take it out, then that money doesn't get to grow. That's the most expensive money you could take out, even though it's tax free. If you take a look at it in total. I would be looking at the brokerage account, unless there's something very unusual there. And again, I'm giving you some generic answers here because I don't know all the specifics. But the one advantage to taking from a brokerage account instead of, say, the IRA is that there will be a lower tax rate. The capital gains rate is lower than ordinary income. And any cost basis. So if I pay $10 for a stock that's worth 15, I can sell it for 15. I'm only going to pay the tax on the $5. I don't have to pay the tax on the 10 that I already used. I already paid taxes on, before I bought it. And so that's a fairly inexpensive versus if I pull that full thing out of my IRA, all $15 would be taxable at a higher rate. Ordinary income is higher in tax than capital gains rate. So I would say look at the brokerage account, as far as that goes. I'd be a little bit careful about really tapping into your emergency fund too greatly. Somehow, some way, you need to kind of replenish that at some point in time. So it'd be interesting to look at that. If you'd like to, schedule an appointment, I could give you some much more specific information on how to do that.
What would you say with the RMD? Like say someone's taking an RMD on a regular basis, would it be a good idea to speed that RMD up essentially and take a kind of a lump sum to pay off that expense?
Yeah, I didn't think about that. It's a good point. So if you're over 72 and you have this emergency, and it's bigger than your, savings, then you are going to be required to take money out of your IRA account. Now, another nice thing about the Roth IRA, you don't have to take anything out of that, which was why it's more powerful. But on your IRA account, if you're over 72 and you happen to be that already, you will be required to take this money out. And so you might as well go ahead and take that out if you haven't already and use that towards this emergency. If it isn't enough, then take the rest from your brokerage account. But that's a really good point. It would only be, important if you, and I don't know your age, obviously, when you ask the question, but it would only be important if you're over age 72. But it is a good point. Take your RMD earlier. If you haven't already, use that because that's going to come anyway. So, I mean, you would have that. And then, take the rest out of the brokerage if that doesn't cover it. Good point.
Let's say I'm retired and I have a big expense coming up in a couple of years for a remodel. Would it be better to slowly remove money from my IRA or take a lump sum when the expense is due?
Okay, that's sort of a little bit like the last question, but it's a really interesting, it's different, and there's some subtle differences there. So first of all, I can't tell from that question whether you have other assets outside your IRA. If you do, I might look at those. So let's just talk about all the possible places you can get money and what the pros and cons are. So if you have money outside your IRA and you're not, at 72 yet, if you are 72, again, just like the last question, you can take the money out essentially, that you have to for your RMD, and then you'd be able to, use part of it for that. But the other aspects of it would be if you have non-IRA accounts, I might take it from there first. If you have money at the bank, as long as you have enough money for emergency funds, any excess funds that you have at the bank, I would definitely look at that. There's not a high rate of return and no taxes for that. Again, I'm just kind of going through the lineage. You could borrow against your home, like a home equity credit line, to do that and then pay it off over the long term. I'm not a huge fan of borrowing, but if you're making a good rate of return in your IRA, and you're, I don't know, making 10% in your IRA and pay 3% on home equity credit line, especially if you could lock it in. Sometimes you can lock those in, pay them off in 5 years. That might be something to take a look at. If we're going to get down to looking at the IRA, then yeah, you're better off taking it out when you need it. And this is something I always tell people, and this is an important component. I just showed you the chart earlier for the 25 years of growth on the S&P 500. If you look at it month by month by month, there's a lot more months where it goes up than it goes down. And so that's super important to know. If I had to take $100,000 out in January or take it out over the whole year to do my remodel, I'd take it out over the whole year because it just allows some of that money to stay in there for months and months and months. And I'm playing the odds, and the odds say that the market's going to go up over a period of time. Now, I could be wrong. It could be right before the 2008 downturn and what have you. So I do want to make sure if I'm going to do that, that I've done it fairly conservatively because I know the money's going to be needed. And so that's where I might, maybe rotate it into something super conservative, like a 20% stock exposure or something along those lines. And so that's another aspect of it. It's not just the rate of return you might get. It's the fact that, you might owe $100,000 for this remodel and then the market falls apart right before you get it out. So there's a lot of different thoughts there, but I might be looking at sort of a dollar cost averaging concept coming out of a more conservative portfolio. If I had $100,000 bill, I might put it in an IRA if that's my only choice. I might move that portion into a very conservative mixture, say 20% stock and 80% bond. And I'd basically take the bet that I could take that out over a period of time to do my remodel. So it depends, on what you really want to do and how that's structured. But again, that would be a good question. That's a good question.
And
We have a question. Go ahead.
Another thing to consider is when you take from your IRA, it counts as income. And so you should be also careful when you're looking at your tax brackets, because they're around, if you're a couple, you're filing jointly, around $329,000, there's a big jump in your tax bracket from 24 to a 32% bracket. And so if you can stay under that bracket, you want to kind of stay below that.
Yeah, that's a good point. So it depends on, how big this remodel is, how much are we going to spend? How much other incomes do you have? And if you feel like, if you took it all out as a lump sum or took it all out even in 1 year, you're going to be over that $329,000. It would be awful nice to split it, So if you're working on that remodel now and you're going to pay part of it in 2021 and part of it in 2022, split it up into those 2 years to keep you under, that bracket. I think it's 164,000 if you're single. So it's another, way to look at it because it jumps from 24 to 32% in terms of that, tax bracket. So that would be another part of the consideration, especially again, if you're taking this money from your IRA, it's going to be taxable.
We have a question directed for Eason asking, why should I consider a 401k rollover to an IRA?
So there's a few good reasons, but I think the biggest reason is when you're in a 401k, you're kind of locked to whatever your plan gives you as investment options. When you roll over to an IRA, it opens the book. You have so many ETFs that you can reach out to and pick. And there's a lot of other kind of like smaller things like you can't do a Roth or conversions with 401ks. They have to be IRAs first. And also when you leave a company, sometimes getting back to HR to deal with your 401k and all that kind of stuff, all that bureaucracy is kind of a pain. And when you roll over to an investment company or to Vanguard or any company, they have a lot better client service than your HR because HR does so much more than just 401ks.
Yeah, it's an area of interest right now in the regulatory arena. The SEC and FINRA are both working on different concepts on how to make sure that people, advisors like us, do a good job advising people on rolling over a 401k. And unfortunately, an advisor has a vested interest in having you roll that over into an IRA because of the fact that, we don't make money oftentimes when it's sitting in the 401k. We make money when it's sitting in the IRA. And so, there is some aspect to that you have to think about, which is just, what is the cost to stay in my 401k? Sometimes that's hard to tell. And that is where you're going to have to contact your HR department to really figure that out. And then what is the cost for wherever I'm going to move in total? All right. And so you've got all these benefits to move, in my opinion, like Eason said, right? You have way more flexibility. You can buy anything. And also, you have this ability to roll it into a Roth IRA, which I think is something that you must look at. But you might not be able to do it, but it's something that is a big, big component of what you would look at here. But you do have to consider all of the costs, make sure that it's going to work for you as far as that goes. But I have an awful lot of clients that basically they just don't want to deal with the old company. I mean, they've left that company, either they retired from it or they left it and went to a different company. Having their money sit in this 401k at a company they're no longer at is just, they just rather continue to roll them out as they move from job to job into their IRA. So there's actually a lot of different arguments on every side. The biggest problem that we're having in our business is that there's just a lot of people that do things wrong. It's like any other business. And so the regulatory agencies are coming around trying to make sure that you're not, getting hit with this, equity indexed annuity with a 20-year penalty that you just rolled your 401k out that had no penalty. All of these crazy things that we keep seeing happening. And that's why these regulations are coming out. But I applaud them. I think, there just needs to be a thought process for why this happens. And I think it's an interesting, it's a good question.
And also, one thing with the 401k is no one's actually looking after it. And so, unless you're actively looking after it, nice thing about if you do it under an advisor, there's someone at least looking out for you.
Yeah, I mean, we charge a fee for the assets under management. So, the more that account's worth, the more we make. The less that account's worth, the less we make. And we are biased in that regards, in the sense that we don't make anything on a 401k in a lot of cases, but we can make money on an IRA. But we're also on the same side of the table. And there aren't any other costs, really. I mean, the transaction costs are zero. There is internal costs, for example, for some of the exchange traded funds that we buy. And so oftentimes we will do a comparison for the cost that it would be to leave it in the 401k and the cost that it would be to have us manage it. But the one advantage to having us manage it is there is somebody actively looking after that. And then you can decide, are they doing a good job or not? I mean, as long as there's no lockup, which there isn't with us, for example, if it doesn't work out after 12 months, you can go somewhere else. I mean, that's one nice thing. Again, if it's in an IRA, you can roll it over to a different place and, get somebody else to manage it that does a better job, or do it yourself. So I think, it just have to be very careful and make sure that you're making the right choice. Not every rollover from a 401k to an IRA is appropriate, and that is why they're doing these regulatory pieces. So do be careful and make sure that you know what you're doing there, because all of the articles read says that this is one of the biggest assets that people have, and that's why they're going after this from a regulatory standpoint, which again I think is important.
We have another great question in asking, I am getting older and I don't foresee me using all of my assets. Should I start slowly gifting over some of my low-cost basic stocks and brokerage accounts to my children or grandchildren? If not, what should I gift?
Okay. Last part's good. So, all right. Let me recap that. So somebody has more money than they need, at least they feel that way. You got to make sure, because you don't want to give away your money and then end up having to ask for it back, basically. So that's where the financial planning process comes into place. We can test things. We can say, hey, what if we give away $30,000 a year for the next 10 years? What happens? Does it work? Do we still have a 99% probability of success, or at least an 85% probability of success, et cetera? So that'd be my first thought there, is just making sure that you actually do have the money to give away. Now, I have a lot of clients that do. We've had, just phenomenal success after this low that we hit back in March, and a lot of people have a lot more money than they thought they would at this point in time. So I've got a lot of clients that are looking at gifting. So let's talk about what you should gift from. So the one disadvantage to what you mentioned, at least up front there, was if you gift, let's say you spent, $10 and the stock is now worth $100. You've had it for a long time. And when you gift that stock to your children or your grandchildren, you're also gifting them that cost basis. So what that means is that when they go to sell it, they're going to end up with a $90 gain. They get your $10 cost basis and it's worth $100. If they were to sell it, they would end up with the gain. If they inherited that stock, when you die, the cost basis gets stepped up to current value. So just for example, if it was still worth $100 when you passed away, then they inherit that with a cost basis of $100, which means then if they sell it, there's no tax. That's a pretty big difference. And so gifting appreciated stock isn't the ideal thing to gift as far as that goes. There's a whole bunch of other places that you might look if you have them. If you don't, and appreciated stock is the only option, then it is the best chance as far as that goes. But if you want to, if you're over 72 and you have to take money out of your IRA, that is cash, essentially, that you could gift. So let's say you had a $30,000 distribution from your IRA after tax. You could gift that away to your kids and grandkids, and, they get the cash. There is no cost basis issue or any of those types of things. And so that gifting cash, if you have enough money, hey, I have X amount for my emergency accounts and I have a lot extra, you could give some of that cash away as far as that goes. So there's a bunch of things that are probably better to gift than the appreciated stock. It's great to give appreciated stock to charities if you do charitable contributions, because they do not pay taxes on that $90 gain I just mentioned. So that's really good. It's even better to give charities money out of your required minimum distributions, because then that tax is gone completely. And that's the best way to give to charities, again, if you're over 72 and you have an IRA for distribution. So there are, a whole lineage of places where you would want to look at for gifting. Make sure you can gift first and then figure out the best place to do it.
We have a pretty good question in here asking, how will the civil unrest in Afghanistan affect the U.S. markets?
Ooh. All right, so this is in the lineage of questions that have come up over the years. When we invaded Kuwait, the second time we went into Afghanistan, right? All of the different things that have happened over the years. Oftentimes, if you look pretty closely, you might see some downturn in the market up front because there's some concern about that particular situation. But unless it ultimately really impacts the economy of the world as a whole, and especially here in the U.S., if you're looking at U.S. equities, it doesn't have much impact. Matter of fact, most of the times, it has a positive impact because there's an awful lot of money spent, in these scenarios. This thing in Afghanistan is a little bit different because we're not involved. I mean, that's why it's happening to a certain degree. It sounds like we're going to get a little bit more involved, but Afghanistan doesn't have oil. So that's a huge issue. If there's a huge problem in an oil area, everybody's worried about oil going to $200 a barrel, which could have a slowing down effect on the world economy. But they do have the largest lithium reserves. I just read that the other day. I didn't know that. Lithium might be the new oil. It isn't yet, but lithium's what they're using to build these batteries out of that we're going to be using for, all of this solar, wind storage, and electric vehicles. And so that's going to be a pretty valuable commodity as far as that goes. And so that's going to have some impact, but I don't expect that there's going to be a tremendous impact from the situation in Afghanistan at this point in time.
Do you think it would affect certain sectors of like the defense spending? So say like your Boeings and your other kind of defensive company, contractor companies, would you say there may be a play to move away from them?
Yeah, to a certain degree. I mean, it's amazing to see the pictures of how much American equipment is sitting there on the ground, that's being taken over by the Taliban. So that was a revenue source for somebody, right? For a while, that won't be. And that's one of the really sad things, unfortunately, about wars or situations like that, is that it is actually economically stimulative to certain companies. And so when we're not there, there's a bunch of money that's not being spent. Personally, I'm kind of okay with that, but that's, purely looking at it from the standpoint of, the economic aspect and how the stock market might react to that. It's possible that there could be some, but I don't know that it's that big. The U.S. economy is ginormous, and there could be some impacts to certain companies, like you said, like Boeing or some of these other, defense contractors, BAE Systems or what have you. But again, I don't think it's going to be a huge issue here as far as that goes.
Are we in a stock market bubble?
Ooh. Okay, that's been asked a few times, rightfully so. If you recall from the slide that I showed, showing the last 12 months, we've had a pretty phenomenal run. Matter of fact, let me share that again here because I think it's pretty interesting. I'll show you the 25-year slide. And I think, so here's 25 years, right? This 95 to 2000 was the greatest 5 years for rate of return in the history of the stock market. And it ended up creating this, what I would truly call a bubble. Price earnings ratios were super high and we dropped down from there. And then we recovered, and essentially we had another bubble in a different area, actually, in this case in real estate, that created these mortgages that weren't sustainable. And, the banking system basically failed for all intents and purposes. And that was a financial crisis, not exactly a bubble, but same result, and that we ended up with a big downturn. But look how long it has been. So basically what happens is the longer you run, the more chance there are. But what people probably don't realize was that this 2000 downturn, prior to this, the next 30+% downturn was 1973, 75. The one prior to that was 1929. They were 35 years apart. And so these happen to be fairly close together. And possibly we're seeing a situation where things move faster and we might see another big one. But it's an interesting question because, we have had this very big run here without any real big downturns. I would say, though, if you look back, okay, at all of these big downturns, they did not happen when interest rates were at zero, where they are right now. We had, I think, 19 to 21 interest rate increases prior to each one of these downturns. And if you look back at most of the big economic, recessions that happened, it was right after big increases in the interest rates. And so the Federal Reserve has said they're not going to raise rates until the end of 2023 at this point. This is 2021. And so that's a couple years away. So yeah, I would say that the stock market is heading in that direction. It always is heading towards a bubble. It's at some point, but it was 35 years between bubbles before. This one happened to be, a lot shorter. But altogether, I'd say that, it's probably not that likely right at the moment that we're looking at a bubble in this environment where the economy is slowly reopening around the world. The vaccine, even though the vaccine is getting a lot of press for people not taking it, if you look at the charts, it's still going up. The people are still taking the vaccine, and worldwide, the vaccine is still getting distributed. And the more it gets out there, the more that the reopening probably can happen as far as that goes. Lots of hiccups. The Delta's a hiccup, all those types of things. But we've got an economic situation that's very nice. Actually, it's opening up very well, and we've got very low interest rates, and we have a Federal Reserve here in the U.S. that seems to be very, very dedicated to keeping those rates low until things get a lot better. And we even have less inflationary, threat than we did even just a few months ago because of the Delta variant and some of these other things, the supply chain issues that we've had that have kind of slowed things down. And so that, I think we're, it's always a possibility. I always design every single portfolio as if there was going to be a giant downturn tomorrow. And you should also always, having said that, trying to guess when it might be. And, if you're running for the hills right now, you might miss out on a phenomenal run. So you got to kind of hang in there and just figure out what portfolio really works for you. All right, good. I really appreciate everybody coming today again. These are really fun. There's some great questions today, actually, some pretty thoughtful ones altogether. So I want to thank everybody. Again, if you want to subscribe, hit the subscribe button. If you want us to email, just email your email address. If you want to, finish up with the, an appointment, then go ahead and do that also. So look forward to seeing you at the next Friday from 12:15 to 1 o'clock Pacific.